Hello, thank you all for being here today, and thank you so much to the limited partner panelists here today. We did the limited partner panel last year at the PREMONEY conference, and we got a lot of really good feedback from the audience. I think around venture capital, generally there's a lot more transparency, but still, for whatever reason, there still seems to be some opacity about the limited partner world, how it works, what the changes are, what the limited partners are really looking for, especially over time as the market conditions change. So we tried to pull together a group of limited partners today that have a fairly diverse and complementary set of perspectives, and we certainly have some folks who are willing to have a counter perspective too, which is great. So I'll just give a quick introduction of everyone, and then I'll ask each of them to provide a little bit more detail about themselves and their backgrounds. So over here, we have Fred Giuffrida. He is a managing director of Horsley Bridge Partners. He's going to be representing a fund of funds perspective. And then we have Aaron Gershenberg, who is a managing partner at SVB Capital. He's also going to be representing a fund of funds perspective. We have Joanna Rupp, who is a managing director of private equity from the University of Chicago. So she'll be representing the endowment perspective, or an endowment perspective. And then we have Jeff Mansukhani, who is a managing director at Cambridge Associates, which is an advisory firm. And interestingly enough, he actually has a dual role, which he hopes he can keep moving forward. He both manages clients, fund manager or limited partner clients, and interacts with fund managers. But he also runs their global research group, so has access to a lot of data that many of us in the room do not have access to. And he shared some pretty interesting data points in our prep call. So I'll just start over here with Fred. Can you just say a little bit more about yourself, your background, your firm, what differentiates you, et cetera?
So Horsley Bridge Partners, we started in 1983 as one of the first fund of funds to get involved in this business, when you actually had to explain that what venture capital was and that you didn't get a dividend check to your investors in the first 6 months of the investment. Today we have basically three things that we do: U.S. venture, international venture, and the really small end of the U.S. buyout market. And so out of currently in the U.S. we invest out of a $750 million pool. And apropos of some of the comments about what the makeup is of those funds, it turns out that for us, about, I think, 50% of the dollars that will be invested in that fund will be invested in funds of smaller than 200 million. And yes, we have some of the big names in the larger size funds and some middle-sized funds. They're not dead yet, quite. And so that's kind of the spectrum that we look at.
Hi, I'm Aaron Gershenberg. I've been with Silicon Valley Bank since '99. And back in '83, when Horsley was getting started, Silicon Valley Bank was just getting started. When I joined the bank, we had 500 people. Our market cap was about 500 million. Today, we have close to 2,000 people. Our market cap is over 5 billion, and we have 26 offices in the US and offices in London, Israel, India, and China. And one of the things the bank does is provide banking services to funds and fund of funds, and provides an incredible platform for someone like me and the team to really start a fund of funds business. So that fund of funds business today is $2 billion. We're in the process of raising our 7th fund of funds. We just closed our 3rd direct fund. And what we focus on is those opportunities to access the best venture funds, right, that are hard to access, because that's what limited partners want from us. And also to access those deals that are the real breakout deals. And then in this environment where it's so competitive and there's so much money, we come up with a very unique strategy in how we go after that money. So we're just coming off a successful raise of 170 million, and we're beginning fundraising our 7th fund of funds, which will be 300 million, hard capped at 330. So we can certainly talk about the fundraising process.
I'm Joanna Rupp with the University of Chicago, and we're a very traditional LP. The endowment is about 7.2 billion. I've been there since 2001 in a variety of capacities. We have a 29-person staff, 19 investment professionals, and 3 people on the private equity team. We invest in 3 different sub-asset classes in private equity: venture, U.S. corporate finance, and international. And in international, we also have some venture exposure. We report to the Board of Trustees, subcommittee, the investment committee, and they oversee kind of setting risk and liquidity objectives for the endowment overall. And then it's staff's responsibility to focus on manager selection and generating the best possible alpha within our individual asset classes.
Thank you. Jeff Mansukhani with Cambridge Associates. I've been with the firm for going on 11 years. And we are a global advisory firm which started in 1978 as the outsourced research arm to the Harvard Management Company. So providing them all of their due diligence and research for the investments that they were making. Eventually this spun out and we started working with some of the other Ivy League schools as well as the top endowments, which explains part of the reason we were early adopters in venture capital, because these were some of the earliest and seed investors in the asset class. So turn the clock forward a few decades and now we're over 1,000 employees. We have offices in Asia, in Europe, Australia, and 3 offices in the US. And we account for about $20 billion in private equity commitments across all sub-asset classes. So a pretty meaningful player. We only work, however, with the owners of the assets. So pension plans, sovereign wealth plans, individual investment offices, and then the nonprofit world.
Great, thanks all. So one of the areas that I want to start off with is really one of the key objectives of the panel. So it's for all of you out there, all the fund managers, in particular the newer fund managers, maybe those who are transitioning their firms, trying to grow bigger, trying to do something a little bit different. What we have asked the limited partners is to provide very candid, constructive, forward-looking thoughts in terms of best practices. A lot of them have been around for quite a while, maybe landmines to look out for, just things that you should really be thinking of as you're going out to raise funds, manage, build relationships with the limited partners, et cetera. And one of the panelists, I will not say who, said that the limited partners have been trained to not necessarily provide candid feedback to the fund managers, so we're hoping to get maybe some candor from the panel today. So the first question, and I'll start again over here with Fred, is, so all of the fund managers here, again, especially the newer ones, or folks who are just getting started in their careers or moving up in their careers, what are the key criteria you look for when you're assessing and selecting?
This is a really hard one because you could do a seminar, maybe a full year class on this. So where do you start and stop? So I'm going to try to focus on 2 parts, and others I'm sure will fill in other parts of it. One is just for what we look at. There was the kind of ongoing debate about big wins versus small wins and consistency and all that. We've been tracking the data for 30 years, and we're firmly in the camp of what counts are big wins. And the stats are that out of all those 30 years, good times, bad times, about 3% of the companies in our portfolios, which have generally been top quartile portfolios, return about 60% of all gains. So 3%, 1 out of 33 deals. And then the characteristics of those, they're all 25 times winners or bigger. So it doesn't necessarily mean that it's the biggest companies so much, although that kind of highly correlates. But it's that, and it turns out that the average of those 3% is actually about 100 times money. So what we're looking for is the way to capture that small number of outstanding investments, really outliers, in the most efficient way possible. So that's a background. The second thing is try to kind of cut through all the criteria you look for. I think what I'd say is focus on what is your sustainable competitive advantage. As you saw, this is now become a very crowded field. I think probably most of the people in this room are more oriented toward the very early stages, but I know there's a mix. But you saw how many funds there are raised. We see, we could probably see one every day in the small end of the market. And to exaggerate for a minute, the pitch is often something like, I'm a smart guy, I got into a tech business, did pretty well, developed a bit of a network, started doing a little angel investing, cashed in, had a little bit of money, did some more angel investing, it's going great, the markups are terrific, and now I think I'm ready to take more money because I think I can, just keep this going. And by the way, there's, like 100 of those. And so in that mix, what is it that's going to distinguish you and allow you to outcompete all those others? Because at the end of the day, that's what it is. And the other trick is that you kind of heard a little bit about this, but probably the last 5 years, if you think of things in cycles, the last 5 years probably been about the best time during a normal cycle to invest. So it's not surprising that people are doing pretty well, but the game's not over. And
Okay, you got to share your quote.
Catherine's going to be, by the way, I'm also the one who said that GPs train LPs to lie to them.
I didn't want to
but the quote is not remarkable. You've heard it before, but we just don't want to be in the position where we are confusing brains in a bull market. So back to it, how do you focus on what is it about you that gives you a long-term sustainable competitive advantage, and then drive your strategy around that. And then there's lots of detail around how you think about that.
I could push on that though one more beat, because I think a lot of us, again, as fund managers here, you got to differentiate, but it seems that there's kind of a flashy brand kind of PR way to try to differentiate, and then there's the actual substantive differentiation that all of you care about as limited partners. So can you add a little more color on that? And I'm going to certainly ask the other panelists too.
Yeah, I mean, it depends. I mean, brand can be a competitive advantage if it drives you to the best deal flow. Brand, if it doesn't do that, then it's more flashy. So I think it's an element of a strategy, and Scott Cooper, represents Andreessen, who's run that playbook about as well as anybody, and it's improved their deal flow.
So what do I like to see when someone comes in? Well, so we sit in a pretty unique place at Silicon Valley Bank. We bank over, as I mentioned, 900 venture private equity firms. We have hundreds of feet on the ground that are going across the country. And so what I like is someone who within the institution says, these guys are killing it. We're hearing great things. We're seeing great things out of them. It's generally someone we've known about for a while. So I would just point out that when you're fundraising, it's really important for you to have laid the groundwork with potential limited partners 1, 2, 3 years in advance to really build that network. And then a lot of people that are going to provide testimonies. And so if it's a first-time fund, it's even more important to have those early sponsors, and the larger the luminaries that are putting real money and real testimonies behind you is important. The second thing that I like to see when someone comes in is that they really have an understanding of where they sit relative to others. So picking up on Fred's thread here, it's that people often have this vision, this passion, this conviction, but they don't really understand that we're seeing everybody in the market. We're getting the pitch from everybody else. So being able to map that market and really understand how you sit relative to others is extremely important. Then I'd say the last thing for me is having an understanding what we, the LPs, are looking for. And this also seems to be lost on a lot of folks, which is what are the return expectations and how are you going to get there? And so this notion, Dave threw out 60%, we use 40% kind of in that seed Series A, somewhere in that range, most of the deals go to zero. And as Fred said, it's 3% that really drive the return. So what in your past would suggest that you can have, you have actually had, we like to see had, or conviction that you will have, a fund returner? And so if you're going out to raise $100 million, do you have something in your past, in your track record, with an ownership, with dollars at work, that is close to what you're raising, that shows that you're going to have, that you've had, or you will have in your past, $100 million? Because we think that that's what drives 3 to 5x returns, which is at the heart of it. For groups that are relatively new, we're looking for those 3 to 5x net returns.
Joanna, interested in your perspective from the endowment. And so one of the things you'd mentioned in our prep call was sort of having a prior relationship with the investment committee. That's one of the things you guys look for, which was interesting.
Sure, and I'll comment on that, but in terms of, I agree with what both of Aaron and Fred have said, but I would also add, we're entering into 12 to 15-year relationships. One of the most important things is a real partnership mindset and alignment of interests. When a GP makes an investment in an operating company, they can go in and replace management, or they can augment management. They have some control. Once we give a GP our funds, there may be some contractual rights, but practically we have very, very little control. So we really, really want to make sure we understand the GP, their mindset, and that they are aligned with us. And that goes to things like terms, size of funds, strategy, et cetera. And in terms of our investment committee, and I need to be careful because I said it's one of the things, and it can be, we're in Chicago, we're not out here. So one of our big challenges is having our ear to the ground. So to the extent that we have investment committee professionals who have a network or exposure to not just venture firms, but other firms, we will ask for their feedback. And it is a very fine line because ultimately staff owns manager selection, and the people on our investment committee are not trained professionals in asset allocation to managers. So they will often have a perspective not understanding what the market is or not understanding who else might be out there. At the same time, going back to this kind of trust and partnership mindset, they may have had business dealings with folks that either help us get very comfortable very quickly or provide some red flags that we can really incorporate into our due diligence process.
Yeah, I'm going to echo a lot of what's been said. And at the end of the day, this is so cliche, but as in every business, it always just comes down to team. And how do you differentiate yourself? And I think I can speak for others in my firm that we're pretty strong believers in behavioral finance. And I think people respond to certain types of incentives, and they're going to act accordingly. So, for example, what is the general partner's commitment? What is the fund size? And I know I shared this with you during our discussion, but I have something called the Sunday barbecue test. If the very hot deal comes across the tape and you get the phone call on a Sunday, are you hungry enough? Do you have enough skin in the game? Are you going to leave that barbecue, or are you going to pass it on? And I think if you're making a lot of money based on stacked management fees and you don't have a meaningful commitment in the fund, I think you're going to stay and flip burgers. So some way, somehow, you need to convey, especially if you're an earlier stage fund, that you have a meaningful GP commitment and that you are aligned with your investors, because, to reiterate the point, these are decade-long, if not 12 or 13-year relationships, and we cede all bargaining power the minute we sign those sub-docs.
So on the GP commit percentage, I mean, that's something that's pretty material, right? Those who are billionaires, it's maybe a little less material for them, but there are a lot of folks in the room who are new fund managers and or building their career. And as we know, a lot in this industry is back-end loaded, right? So you're investing in your fund, you're trying to probably raise a family, buy a house in this crazy area, et cetera, too. So just a quick survey on the panel. In terms of GP commit, it's somewhat it's somewhat contextual, but what's your perspective? What is material? It sounds like typically kind of in the range of 2 or 3 to 5% is what do you look for?
I'm an outlier on this one. I think if you think about it, alignment comes largely from the carried interest. So the issue of how much you stretch people on the other side is really designed to make sure that they have an appropriate level of risk aversity. Right, because now they have real money in there and they could lose that money. And I think in some funds, in like the buyout world, I worry about that a lot more, but I think there's a balance here. And if you push that too much, you start to put too much risk averseness in the program. And the last thing I want, at least, is a risk-averse venture capitalist, because I'm looking for those 3% outliers. So I think needs to be a balance. I think it should be meaningful. I think it needs to be meaningful within the context of people's net worths. 2 to 3% maybe definitionally just becomes your net worth starts to limit your fund size, and that doesn't necessarily seem to be rational to me.
So I think what Fred says makes sense. You want people to take risk, but at the same time you want to believe that they have the same conviction that you do, that this is the best place for them to put their money. And so one of the worst signaling things is when someone's raising a subsequent fund and they're reducing their GP commit. So, for me, I like 2 to 5% typically, and I get excited if I see someone willing to put up 10%, especially if it's cash, not a deferred management fee. And we've invested in funds where the GPs are putting up, significantly more than that. But it is certainly something to push on.
What about you, Joanna?
And I don't have too much to add, except it is a very strong signaling impact if somebody's putting up more than 5%.
Yeah, and I think Fred raises a good point. I certainly expect the venture capitalists to be prudent in their own personal balance sheet. So I don't expect them to have half of their entire family net worth sitting in high-risk capital, but at the same time, it's this meaningful number, and that varies depending on the different fund and the different strategy. But the math is pretty easy when you start breaking down a fund and how much a GP is going to have to pay out each year. And it's interesting, even based on 1% in a $250 million fund, if you have 5 investment partners, pretty close to about $35,000 per year that is at-risk capital for that investment partner, and that's not that meaningful, especially when you consider they may be stacking on funds subsequently. And I always find it entertaining in some of these meetings we have with some of the firms, and they'll come in and tell you about all the numbers they've put on the board, all the billion-dollar exits they've had, how great they've invested. So mentally, you're running the numbers thinking, geez, they're taking 20% of this, and I know that you've been with the firm for 15 years, and you're fully vested, and 100 million, 200 million, 300 million. Oh, and we're going to put up a 1% GP commitment with half of that is offset with fees. That doesn't work.
And to continue the sort of just looking at it from more of an analytical, quantitative perspective, what do you look for specifically in terms of net multiple and/or IRR? So with 3 to 5x net or greater was mentioned. What do you have to say about that, Jeff?
So are you asking what I want or what reality dictates?
Both.
So if I'm looking for a fund right now, I don't place quite as high an emphasis on IRR. And certainly it's debatable, a case can be made how important that is. But I focus more on the multiple. And I'd like to see a 2x. I'd like to see money coming back in 5 to 6 years. I do not like extensions. I understand they exist, but I prefer not. Why the 2x? Why not higher in venture capital? If you go back to 1981, across all venture capital funds, regardless of size, about 26% of those funds have had a TVPI of 2x or better. So then I have to ask myself, if that's 26%, presumably about top quartile, is giving you a 2x or better, how confident am I that I can A, be top quartile and get that 2x, but realistically, can I expect a 3x? Probably not.
I'll take a slightly different view. We have corporate finance buyout guys that we talk to all the time that we have an expectation they're going to get 2 to 2.5 and mid-20s net. This is a much higher risk asset class. It's much more difficult to access. We go in with an expectation that we're going to get north of 3 times. And if we didn't have that expectation, we wouldn't be making a venture capital investment. Now, there's the reality and there's the expectation. I think the other thing that we focus on, because it is such a long-lived asset class and you don't really know, we're evaluated versus the Cambridge benchmark. So we take a very bottom-up approach to allocating capital, and it is about finding those managers who we think will be in the top 10%. And if we don't have a manager that we think really has a high probability of being in the top 10%, we'll allocate the dollars to someplace else in the portfolio.
And how about either Aaron or Fred? Do you have something else to add on this?
So I think that on the net IRRs, we're looking for high teens, low 20s, and certainly for the earlier stage, smaller funds, we believe 3 to 5x and greater is achievable, and we see that in our portfolio. But for the larger funds, which are investing more in the a significant amount of capital in the growth expansion space, then we think a 2 to 3x net is reasonable.
Yeah, 2.5 and x net and 25% is what we're looking to achieve across the portfolio, but we know that not everybody's going to do that. So what we want is every fund to have that opportunity to blow it out on the upside. So it's not just a number, because nobody's going to hit the average. So it's more about putting upside in your portfolio.
Great. So I'm going to touch on the, each year. Last year there was sort of a particular hot topic we touched on, and this year I think the big topic up for debate that's getting a lot of attention is large fund or small fund, right? A lot of billion-dollar funds, quite a number of billion-dollar funds being raised. There are some mid ones, as Fred alluded to, and then there's the smaller ones. So, for all the fund managers in the room, especially those who are thinking about, what do I do? Do I go and find some more partners, build a larger fund? Do I stay small? Do I grow? What should I do? What words of advice do you have in terms of large fund versus small fund?
Well, I think for a number of reasons, as you get larger, the ability to hit the kind of returns that we're talking about get more difficult. In part because increasingly that tends to push you to later stage investments. You end up competing with people who have lower cost of capital, at least perceived cost of capital. So there's a variety of reasons. Now that doesn't mean that people still can't achieve it, but I think it means is you really have to be looking for people that execute at a very, very high level. And honestly, venture capitalists tend to look a lot more at the businesses of the people that they invest in than they do at their own. So not that many of them are really optimizing and really working hard at their own internal operations. So I think it's a hard place. I think it can be there. On the other hand, the small funds have a series of risks. So, you know, again, I come back to, there's going to be a lot of failure in that level. So you got to have that competitive advantage and execute at that level too. But it's a little bit different what you have to do.
So for me, I have less of an issue in terms of the big brand name firms raising more amounts of capital when we see them putting that money behind the big whales that they've kind of locked into. And certainly, since we believe that 8 to 12 companies move the needle on the industry every year, if one of our managers is a proven track record of getting into those deals, then we have no issue with them having additional capital to back up their bets. Where we have a challenge are at the smaller size. And so our analysis suggests that $35 to $50 million per GP is the right size for that early stage investing. And that's where we're having the biggest challenge in this market, because there are folks who have had some significant outcomes, but there's a lot of money on the sidelines, LPs who've kind of walked away and now walking back to the industry, who are, that number's drifting up. It's drifting up to 60, 70, 80 million per GP. And that's where we have a real challenge. So we really like those GPs who are disciplined about their fund size. They're really in it for the carry. And again, going back to that alignment of interest, there's good alignment of interests.
Great. Joanna, do you have anything else to add?
I think it kind of goes back to return expectations as well, because it's much easier to get a multiple of fund on a smaller fund size. And I think also to kind of the partnership mindset, we don't have a strict set of criteria around small versus large, but it really needs to be a thoughtfully sized fund that matches the number of partners and the strategy. And to the extent that we see funds increase in subsequent fund rounds, we typically like more modest increases rather than, I was successful with X and now I'm going to go do 2X.
So I think these are all great opinions from my fellow panelists, and I'll let them handle the opinion part of it. And we house a lot of data, so I'm just going to provide some boring data to give you some context around this. A lot of us may recall a few years ago the Kaufman report that was published, and it really, I don't want to say indicted, but it called into question some of the returns in venture capital. And as a result, a lot of our clients challenged us on the asset class and the exposures they had and wondered whether they should continue funding venture capital going forward. So we ran a lot of numbers, looked at the analysis, and some of the outcomes were actually pretty interesting and really favor smaller funds. So we looked at what is a successful fund, and I think we were pretty liberal in saying successful was a 1.75 TVPI and a 12% net, number that's far lower than anybody here would talk about having a goal in venture capital. And if you look at those numbers and you use $250 million as the break point, you are 8 times more likely to hit that 1.75 and 12% under 250 than you are over 250 as of 2012 when we published this report following the Kaufman report. So I haven't tracked all of those numbers since. I think the industry has improved somewhat. So maybe that's not quite an 8 to 1, but it's not 2 to 1. So what I did look at in advance of this discussion was I used 500 million as a break point and tried to run some numbers around that, because we are seeing more and more venture firms moving into the growth capital space, and what do the returns look like for a fund that's over $500 million. And if I were to ask you, if since 1981, what percentage of funds, venture funds over $500 million had a DPI over 10%? Do you think they would or wouldn't? 6%. 6% of venture funds over $500 million have produced a DPI over 6%, and 8% have had a TVPI of over, 8% is the average TVPI for the $500 million funds. Now, those numbers quadruple for funds that are under $500 million. So again, this is data. The industry has changed. I'm talking about 3 decades, so there's a lot of qualitative overlay here. But I think it is important to look at the numbers. I had my old corp strat professor in business school said, Jeff, you're a nice guy. I appreciate you being in here and making contributions. But if you can't back up what you say with a number, keep your hand down.
Thanks, Jeff, for sharing the data. Another area that's being somewhat debated and certainly seems to be happening a little bit more, I think particularly because the markets are pretty good right now, is the whole concept of co-investing. So limited partners invest in fund managers, and then they use that to get data and then want to co-invest separately in the best performing companies within the fund. And that certainly can put fund managers in an interesting perspective. It's particularly prevalent among certain fund of funds, because then you have limited partners who are trying to compete against each other to co-invest in a follow-on round with your best performing companies. It's an interesting thing to manage. So in our prep calls, the majority of the panelists didn't seem to be super bullish on the longer term prospect of LPs co-investing with their fund managers, but we'd just love to have you share any color in particular around that.
I think we fall in that camp. I think there was a recent academic study out of Harvard that looked at co-investing and said it hadn't actually lived up to primary fund returns. I mean, that's been our experience. We think there's a bit of adverse selection, both in terms of what deals you're offered by your GP, for co-investment. It also tends to be later stage deals, which we think have some adverse selection process to them. And I think it also causes people who practice that to some level of adverse selection on funds, because the funds that provide the greatest degree of co-investment tend to be the ones that are having a harder time raising. Now, those are all generalizations. That doesn't mean you can't run an effective co-investment program. But I think you need to be very thoughtful about how you do that, and again, what specific advantages you bring in order to offset some of those natural tendencies.
Yeah, and we're not a fan of co-investments, especially where the GPs are getting economics on those co-investments. We think that sets up the wrong dynamic. GPs, we believe, should be focused solely on, again, alignment of interests, making money off the funds that they're managing for all the LPs. And so we think there's too much money in the industry when you look at the corporates and you look at the late stage investors. So what does an LP who is filling out a round really bring to that situation, other than potentially overcapitalizing the company, or a company which the existing investors don't have that conviction in? So our direct strategy is much different. It's pricing preemptive inside rounds, so where the existing investors are greedy, and that's how we approach them, and we say we think you should be greedy in this deal and you should do a preemptive inside round and increase your ownership. So that's how we've identified a way to, in our minds, be less competitive, non-competitive, and address this issue of too much capital in the market. So not a fan of co-investments.
Joanna?
I think your comment about smaller funds delivering better returns relates to this, and also kind of alignment of interest in maintaining your discipline. And I think if you have a co-investment program, maintaining that discipline becomes much more difficult, and it sets up some potential conflicts of interest with LPs who don't participate in co-investments, and it's just distracting. So we don't tend to like it.
Yeah, I think this is one area where I veer a little bit, and again, I recognize that the data is stacked against us, and I think Aaron probably has a very unique view with the bank, seeing how some of these rounds are financed. But I'm a little bit more open-minded. I don't want a fund strategy built around co-invests. I don't want to expect the co-invest, but if somebody that I've underwritten, that I, after months of due diligence, have confidence in their strategy and their approach to investing, and they've come across a really interesting deal that needs additional capital, and they've given myself and others a call, and I have a chance to re-underwrite and look at the deal again, I think it's fine. Again, I wouldn't want to build a practice around it, but I think that you can make marginally more money on particular deals. So it's more of a one-off for me.
Great. I love the contrarian perspectives we're getting. You're not okay. Got it. Thank you. So I'm going to ask one more question, and then we should have time for one more question from the audience. So I'm just going to give you a heads up to make sure it's a really good one to end the panel session with. So the final question from me is, what changes do you see coming either on the LP side and or fund manager side or just market conditions generally that you think we should all be aware of, we should be thinking about as we're constructing our portfolios and raising our funds? I know that that Fred has a perspective that there is some sort of a correction coming, but I'll just start over here with Jeff first and just kind of words of advice in terms of changes that might be coming.
Yeah, I think a constant theme you're hearing is that venture capital is not private equity or buyouts. And just stay true to being an entrepreneur and a visionary and resist becoming an asset manager, because we can sniff that out and we sit in a room and we can tell the people that are starting to transition from being really creative to starting to think more like corporate finance people, and it doesn't seem to work in venture. Look I'm wearing a suit and everybody's in jeans, so say no more.
He said he just about wore a tie, but he didn't. So that shows good thought.
You all are closer to this than I am as an LP. I guess the one trend that was alluded to or mentioned in the slides this morning, and I've heard from some of our other GPs, is just the growth of the seed stage funds and the importance that those funds are going to be playing in the ecosystem. We've also talked with a lot of folks about some of the changes in geography, and I know everyone's very bullish on the West Coast, but I think that there's more going on broadly than might be acknowledged if you're not here in the West Coast, but that's a Midwesterner's point of view.
So based on my short, I think close to 20 years in the innovation economy, I think that this is the most exciting time I've seen. I think that the size of the industry, the global nature, the capital efficiency, you can go on and on and on about the platform companies that are getting created. In fact, I'll just, a short story. John Mumford of Crosspoint back in 2000 was raising $1 billion fund, and he returned all the capital back to his LPs. And he said, I don't think we will ever see another $1 billion IPO, right? And he couldn't have been more wrong. And if you go back in time, you see this over and over again. The industry gets written off, gets written off, gets written off. Well, we're in a time where I think that one of the reasons the room is so packed is that we all have this conviction that the best is yet to come, and certainly we do at Silicon Valley Bank. But the overlay is that there's a ridiculous amount of capital, and there's a huge amount of capital, trying to get into this industry. And so that potentially pollutes returns. That's one. The geopolitical risk, the global macroeconomic risk. So it's not without risks. So what else should we think about? When you raise a fund, it's an incredible business. To Jeff's point, when you layer fees on top of fees, you can take down a few $1 million a year in salary without returning any money. But I will tell you, when you raise that fund, it's a pretty intimidating, daunting task when you start getting those management fees and watching the TVPI at 0.8, 0.6 as we did in our first fund. And of course, hugely rewarding when you start getting into those 3, 4, 5x net returns. So I just caution everyone in the room to be very deliberate about the prospects of raising a fund. Is that the best thing to do versus maybe some really innovative models? So I know Naval's coming up next. I'm not pandering to him, but I think that what he's doing with Maiden Lane and other examples like that are some of the things we need in the industry. Some real thoughtful looks at the business model and the approach, because we really need this. We need this economy to thrive, and I think some of those things are going to help drive it.
I agree with all the things that Aaron said about the macro opportunity and the pace of change, et cetera. So I think that's all absolutely right. I do think, though, that the cycles of finance, which probably relate to human psychology more than anything else, are rife, and so that this discussion about bubble, is there a bubble or is there not a bubble, is just too simplistic. There's kind of two things that venture capitalists do in a very simplistic way, is they invest and they exit. It's a great time for exits, and I think it's going to be a good time for a while more. I don't think we're seeing any real evidence of bubble-like behavior in the public markets. I think we'll have some more time and let the good times roll, so I'm not a pessimist. However, the other side of it is you have to look ahead, and investing is about looking ahead, and Scott kind of alluded to this. You can feel some of the pressures building, whether it's competition, more money, pricing, just the way people are thinking about it. I'll take the best analogy I'll steal from Bill Gurley, who talked about the frog in the pot. And the heat is slowly rising, and it's imperceptibly rising. But if you look at the signals, it's rising. So where are we? I don't know for sure. I kind of think we're at 160 degrees, give or take. And maybe that means, you know, if you had to pick probabilities, there's going to be a major correction sometime in the next 2 to 4 years. And if that's true, and God knows there could be a bomb goes off tomorrow someplace in the world that could make it happen tomorrow, and we might have a series of softer corrections that make that period go out further. So who knows? But if it is 2 to 4 years, this is the most dangerous time to start a fund. This and over the last couple of years, because by the time that hits, you will have spent all your money and your reserves, and it'll be difficult times, and people haven't seen that in a while, and they're mostly focused on what's worked in the last 5 years. It's a different environment in the next 5 or 10. That's it.
Thank you. So I know we're just right at the end of time, but I'd love to have just one really good, quick question from the audience, because I promised it. Does someone have a really good one to end the session? Yeah.
The Katherine report also mentioned that VCs are going for disruption, but the VCs themselves don't show any disruption. Where you guys are seeing any disruptive processes or structures where you say this got to be happen over the next couple of years?
Okay, so the question is, the Kaufman report talked about the fund managers going after disruption, but is there actually disruption happening among the fund managers? So really quick comments from any of the panelists about sort of disruptive fund management approaches that you're seeing.
Andreessen, it's completely changed the game. And every other firm talks about it and tries to figure out what they have to do to compete with it, even while they're denigrating whether it works or not. We'll see how that comes out, but it's a pretty profound change. The whole seed thing, the fact that you're all in this room, is vastly different than it was 5 years ago. The whole landscape is changing over. Every firm is at risk. There's plenty of creative destruction. Not everybody is addressing it the way they should, but there's a lot of creative destruction in the venture business right now.
And for me, I mentioned it, it's Maiden Lane, it's a 30% carry-only fund, backing half of that carry behind angels who are investing off of AngelList. I think that's really creative.
Joanna?
I would have agreed with Andreessen and Seed.
Jeff, anything?
Nothing to add.
Great. Thank you so much, the panelists. Really appreciate your candor today.